Welcome to the Unconventional Wisdom Podcast with Ed Rempel, the show about the most effective methods to achieve financial security and freedom. Find out what really works. Insights are based on in-depth experience from a fee-for-service financial planner, tax accountant, Canada's #1 financial planner blogger, and your host, Ed Rempel.
In the recent video, Ed Rempel, a fee-for-service financial planner and tax accountant, discussed how the wealthy became wealthy and whether their strategies can work for you. Joining me now is Ed himself, who can talk about how you can achieve financial success and the steps to get there. Ed, thank you for joining me again.
Great to be here, Barry. This is a fun topic.
I think one of the top questions for this topic is going to be, how much do you need to get wealthy, Ed?
Yes, so we try to make about a definition for wealthy. So, basically wealthy is having investments that will provide comfortably more than your desired lifestyle for the rest of your life if you choose not to work. It's financial independence plus a very large cushion. This is kind of how we define it. Now, 20% more than your financial independence goal is the margin of safety. So let's say wealthy is 50 to 100% or more ahead of your retirement. You have a goal in your financial plan of how much you need to be financially independent. So 50 to 100% more or more than that is, I think, how I would define wealthy. So it's enough you don't have to worry about money. So for most people, that's 2.5 to 5 million in investments, excluding your home. So, now, of course, there's a big variation. Some are much higher, much lower, but that's kind of the average that I tend to see. I'm talking about the future number also, too, for people saving. Yeah, but that's what I would call wealthy.
Okay, so naturally, what types of people have that kind of high net worth? Because 2.5 million sounds ridiculously high for me, even though I think I'll get there, maybe not, but I'm sure you're going to break things down and make people feel a little bit better about themselves.
Yeah, we used to think, being a millionaire is a lot, but it's actually not a lot today. People with high net worth, so the wealthy are mostly older people that saved and invested effectively through their life. That's but mostly who they are. So very few inherited it. So I went to the Forbes 400 richest and only 13% of them inherited it. Most inheritances are received in your 60s and 70s, which is likely too late to grow it enough to be wealthy. Most parents want to enjoy their life and not leave a large inheritance. So most inheritances are not huge. So now almost nobody wins it in the lottery. The odds are against you. So where do they get it from? So, almost all millionaires and even billionaires made it all themselves. That's how they do it. So wealthy grow it through investments or in a business. So the high income is helpful, obviously, but it's not essential. So it's not what you make; it's what you keep that matters. So high income comes from learning a valuable skill. So some, not nearly all university degrees, teach you a valuable skill, such as the STEM fields like IT and engineering, or the sales, or the trades actually do quite well, or skill as an entrepreneur. Those are kind of the valuable skills. And, wealth builds with age. The wealthy are mostly older people, say 50 plus, who saved and invested over the years. So, and the thing about this is actually great news because that means you can do it. It's not something that's, you have to have rich parents for it. No, anybody can do it if they, if they just save and invest effectively over the years. And actually, so if we look at net worth by age, you very definitely see it. Like the average net worth of people with 25 to 34 is like 336,000. 35 to 44 is 655. In the 50s, it's 1.3 million. From 55 to 64, the average net worth is 1.6 million. And then over 65, it comes down a little bit, but that's because people are taking money out. But you see, it's the people over 50 that have most of the money.
One term I've heard a lot about is productive growth assets. Can you explain that to everyone?
Yes. Yeah. So to become wealthy, your investments should be productive growth assets. So that means it's a good rate of return that's reliable long term and significantly more than inflation. And it's in assets that you can use for your lifestyle in the future. The biggest one there is stocks. So stocks globally have averaged, like long term, the average has been about 10% before inflation and 7% after. That's been kind of the average. US has been higher. more like 11 and 8. Canada's been lower, more like 9 and 6. And then the other one is real estate. Real estate is long-term average about 6 before, about 3% after inflation. So, but those are kind of the main growth assets. But but stocks, equities is kind of the main thing. So the top 20% of people, so not the top 1%, but the top 20% in net worth, mostly have it in their house. And for many people, and the thing is, your home is not a productive asset unless you will use it for your retirement income in some way. Right. So it's just, if you're just going to live in it and never use it for anything, it doesn't actually help you. So it's not a productive growth asset then. So the ways that you could use it is, one is you sell it and downsize to a much lower cost home, or you sell it and rent sometime in the future. Then you get the money out. Then it could be a productive asset. You could also borrow against it to invest, like the Smith maneuver or something, or you could borrow against it to spend. Like some people just when they retire, just get a credit line on and just slowly spend their equity. But unless you get your money out of it for your lifestyle somehow, we don't count it as a productive growth asset. We don't count it, for example, in a retirement plan. So to become wealthy, build your net worth of productive growth assets, excluding your home. Now, the wealthy are growth investors. This is usually stock market, equity investors, or they're business owners, or they're investors in leveraged real estate, like with a large mortgage. So real estate with a large mortgage can be a good investment, but paid off rental properties are usually low return and high tax. So with real estate, you kind of have to have a big mortgage on it for it to have a good rate of return. Equities, the stock market, or equities, as we call it, is the stock market or its businesses. The stock market really is businesses as well, are the highest growth asset class. So equity investors and business owners are both investing in businesses. And that's kind of where the growth is. And I actually have a chart that shows the wealth over 40 years, over the last 40 years in stocks versus fixed income, like bonds, versus real estate. And this is in Canada, here in Toronto. So the average home in Toronto in 1974 or 1975 was 53,000, and now it's just over 1 million. But that same 53,000 in bonds would be worth 825,000, so almost as much. But if it's in global stocks, it'd be worth 14 million. So it's way more. You see, it's so much more growth. And that's kind of the secret, is you have to have it in things that grow a lot over time. And the stock market has been reliable in history over long periods of time. It's an investment in businesses that tend to grow their profits over time. So note the worst 25-year gain, calendar year gain in the modern stock portfolio, like since 1930, has been 8% a year. I have a chart there that shows all that.
So Ed, earlier you talked about how you would need roughly 2.5 million to retire, but how much do you need to become wealthy?
So the 2.5 million, to become wealthy. That is wealthy, 2.5 million. You may not need that much to retire. I mean, that's being ahead. But the question is how much you need to save. So to become wealthy, you got to save and invest for growth over the long term. It's got to be a healthy amount that you save, and you got to get a decent rate of return. So for long periods of time, like 30 years, including inflation, you need purchasing power to, you got to include inflation long term, because it's inflation, it's purchasing power that matters over 30 years, not just rate of return. So how much do you need to invest? So I have some examples here. So 1,000 a month could get you to 1.5 to 2 million in 30 years, which is probably not wealthy. So, I mean, wealthy is an individual thing. It's how it fits for you and what it does for you. But, the cost of living doubles every 30 years. So, if you get to 1,000 a month, let's say it gets you to 2 million in 30 years, that buys you basically what 1 million buys today. And if you retire and withdraw 4%, based on the 4% rule, that's 40,000 a year, which isn't really wealthy. You think, oh, I got $2 million. But you know what? That buys you what 40,000 a year buys you today. So I don't know if I'd call that wealthy yet. So now 2,500 a month can get you to, 3.5 million after 30 years, which could be wealthy depending on how your lifestyle. So the cost of living doubles every 30 years. So So it could give you somewhere between 3 and 5 million is what I mean. So if you get to 5 million investors, so this is 2,500 a month growing, it could get you close to 5 million. But it's 2,500 a month like through your entire career. So 5 million in 30 years is like 2.5 million today. If you use the 4% rule, that's 100,000 a year. So having enough money to support 100,000 a year for life, growing by inflation, that you might consider that wealthy. That's, a reasonably comfortable lifestyle. You got enough, so you never have to worry about living on 100,000 a year. So if that's enough or more than enough, then you could consider that kind of wealthy. So 2,500 is kind of a decent number. Now 2,500 a month is 30,000 a year, and that's kind of roughly what the RSP limit is for higher income people. So it's not a bad idea. Like I think you may find a fair number of people actually want to put in more than that because maybe 100,000 a year is not wealthy for them, or you know what I mean? It's not. So it depends on the lifestyle you have. Now, higher income people can get a refund on 40 to 50% of RSP contributions. So the after-tax contribution, of 30,000 a year is more like 15 to 18,000. And most higher income people should be able to do this, or more. So it's, higher income people can usually, if they put their mind to it, start young and save regularly and effectively. It's something that's reasonable that many people should be able to do. For more unconventional wisdom insights, follow this podcast and share it with your friends. I sometimes refer to a chart or image. Don't worry, if you want to see the chart, it's on my YouTube channel in this video with the same name. You can be the first to receive all my new podcasts by subscribing to my email list at www.edrempel.com. My services and costs are at edrempel.com/help. You can request a free 30-minute consultation at edrempel.com/talk, or share feedback and topic ideas at edrempel.com/feedback.
So for those who don't necessarily have a high income or struggling to save, 1,000 a month, 2,500 a month sounds a bit high. Would it make sense to borrow to become wealthy?
Well, yeah. So borrowing can help a lot. Now, it's not necessary. You don't have to borrow to invest. Just you save and invest effectively and over the long term, and you can get there. However, borrowing to invest does help a lot for wealth building. So now the highest net worth people usually did significant borrowing to invest. So nearly all of the very wealthy people borrow to invest in investments or in their business. So, for example, they can do Smith maneuver or investment loans like 3-for-1 loans. For investors, most businesses have significant investment loans that they use. And also, real estate. The other one is real estate when you have a large mortgage. These are all kind of ways that, people have built quite a bit of wealth with those. So borrowing to invest makes it far easier to become wealthy. And if you look at an example, you can kind of see what the effect is. So let's say you've got $2,500 and you invest for 30 years, you make 10% a year. And so your investments are about 5.8 million. That's just no leverage. You just did 2,500 a month for 30 years. Then let's say now you borrow to invest. So you borrow $1 million to invest for 30 years. You get 10% growth and you get a loan of 5% and 40% tax. So your payments after tax are 2,500 a month. So it's the same cash flow. But now instead of having 5.8 million, you have 16.4 million. So basically you have almost 3 times as much over 30 years by borrowing to invest. So it can help a lot to be able to do that.
We've talked about this before, but what does the life cycle investing study tell us about growing wealth?
Yeah, so I have a study in my blog on life cycle investing, and it's not. There's a recent study in equity that we talk about life cycle investing. It's not that. It's an older study with a couple of finance professors. It's a specific strategy that they worked out. So life cycle investing. It's a study by 2 Yale professors about saving for retirement the same way you buy your home. So borrow as much as possible when you're young and pay it off by your mid-50s and move to your target asset allocation by retirement. So that's kind of what you do with a home, right? You borrow a huge amount to buy the home and you pay it off by your mid-50s. So what if you do your your retirement savings the same way. And what that study showed is that 100% of the time, the people had more wealth than the normal bit by bit savings. Like usually you start with zero and you put in 1,000 a month or 2,500 a month and you build it up. What they found is going out and getting a big loan and paying it off by your 50 over like they went back 150 years and they found every single person that did it had more money after 30 years. It was shocking. There's 100% were better. And now it works for two reasons. So first of all, it works because you start with a large investment portfolio when you're young, so it grows to a lot more wealth. So you just get a lot more money invested, and it just grows fast. So, but you don't wonder why wasn't it? Why is it 100% of the time? Like, didn't it fail sometimes when the stock market wasn't good? And the reason for that is this borrowing to invest, it gives you more reliable growth because it reduces what's called last decade risk. So if you invest for 40 years from age 25 to 65, let's say you're just doing it bit by bit, 1,000 a month, your investment returns are low in the last decades, from age 55 to 65, then your 40-year return is low. So it's that last decade that all that matters, because nearly all your investments are held in the last decade. Like if you look at a chart of how your investments grow over 40 years, it's the last 10 years where you got all the money in there. So if that's a bad decade, then you get crappy returns. So now the rate of return when you're 25 to 30 or 35, first 10 years, it's almost irrelevant because you have hardly any money invested at that point. So the conclusion is when you're young, having a large investment portfolio is what matters much more than the rate of return. So to build wealth, try to get as much money invested as possible when you're young, and it can grow for 40 years, even if you have to borrow it. So now note here, this is not for everyone. I'm not recommending this broadly. I'm just saying it's a strategy that works. So it's only for growth-focused people that want to focus on being wealthy and who will stay invested for the long term, right through all the bear markets.
Now, I know you've talked about this a little bit throughout our chat already, but how do you become wealthy? That's what people want to know, right?
Yes. How do you do it? Yes. Well, so for the wealthy are mostly just older people that saved and invested effectively through life. So you'll probably get older eventually. All you got to do is save and invest effectively before that. So, which is kind of great news because it means you can do it. It's not something that that's impossible. So, you just got to save a good amount and invest for growth over the long term. And there's kind of 4 steps that I think are kind of the most effective way to do it. So, first thing is you actually need a financial plan, and so that like what does wealthy mean for you? Like how much is it? It's not the same number for everybody. Let's say it's 50 or 100% more than what your retirement goal is. So what would that number be? So it could be 2.5 to 5 million, or it could be lower or higher. So now you know how much you need to save. With a financial plan, you know how much you need to save, and you also know what rate of return you need to be able to get there. So now you got to, okay, I've defined what wealthy is. Now, because you're doing this over many years, let's make a plan, and then you know what you have to do, and you've got the type of investment, and you're investing the amount that should be able to get you there. So is it possibly 2,500 a month or more, and a return of 8% a year or more? Like it's that kind of numbers that tend to make you wealthy. Your financial plan is the GPS for your life. Like it's like the difference between driving with and without a GPS is like life with and without a financial plan. It keeps you focused on the long term. It helps you avoid short-term mistakes. That's step 1. Step 2 is wealth builds with age. So invest as much as possible when you're young, even if you have to borrow it. So this is, save and invest early, benefit from 40 years of compounding. Now, I admit that this is hard because I know a lot of young people, cost of living is crazy these days. And when you're young, your income isn't that high, and you're trying to buy a house and get married and have kids. And, so it's not easy when you're young. But if you want to be wealthy, that's what you need to do. Step 3 is invest in equities, that's stock market investments, or in a business, or in real estate with a large mortgage. So it's like with real estate, you basically have to borrow to invest to make it effective. Stocks and businesses, you don't necessarily, but again, it makes it much more effective. And step 4 is, borrowing to invest, that's leverage into equities, is the most effective growth strategy. if done by the right people in the right way over the long term. So that life cycle investing study, it's an example of how this can work over decades, and it provided a more comfortable retirement and a higher wealth 100% of the time in the study. So it's a strategy that just tends to work, over time if you're the person with a high risk tolerance that can do it. That's how you become wealthy.
Sounds simple enough, but it's never that easy, which is why there are some great resources like yourself. So how can viewers get a hold of you, or how can they see more videos and read what you've written?
So I have a blog, YouTube, and podcast. Blog is Unconventional Wisdom. It's actually the number one blog in Canada for a full-service financial planner. It's just my name, edrempel.com. It's also unconventionalwisdom.ca, just .ca because we're in Canada. My name, I got .com, but Unconventional Wisdom is just .ca. Couldn't get .com. Now, we offer a free 30-minute consultation if you're just potentially interested in talking with us. So it's just edrempel.com/talk will get you there. Podcast is edrempel.com/listen. YouTube is edrempel.com/watch.
Okay, Ed, that was great. Thank you for joining me on the Canadian Financial Summit again this year.
All right. Always great to be here. It's a lot of fun, Barry. Thank you for listening. For more unconventional wisdom insights, follow this podcast, give it a review, and share it with your friends. Be the first to receive all my podcasts by subscribing to my email list at www.edrempel.com. My services and costs are at edrempel.com/help, and you can request a free 30-minute consultation at edrempel.com/talk. I often cover listener questions, so if you have a burning question or topic on which you'd like to hear unconventional wisdom, please ask or share feedback at edrempel.com/feedback. See you next week.